Good morning, everybody. So it's now September 12th, rolling into the end of the third quarter. Mortgage rates are falling dramatically. Finally, they've stayed higher for longer. So there's lots of dynamics shifting in the market, and we're going to keep our eyes open and look at what we can see now and what we can expect for the market to happen in the rest of the year and set us up for 2025. I am Mike Simonsen, and before I dive into the data today, remember that at Altos Research, we track every home for sale in the country every week. I'll do all the supply and demand, all the sales, all the pricing, all the changes in that data. And that's what we do for you every week. If you are new to Altos and you haven't yet downloaded our ebook, our free ebook, How to Use Market Data in Your Real Estate Business, you can go to the Altos website, or there's a link in the chat to download that now. And it really talks about how to use the data in the same way that I talk about it in these webinars, and I talk about it in our weekly videos, how to use the market reports, how to communicate to buyers and sellers. It's free. You can follow the link in the chat. As always, there's a chat going on here. Lael and Jeff from the Altos team are in the chat. You can go there for the links. And if I'm referencing things, you can use that for places for questions along the way. If I am referencing things that like have a link or a download, go to that chat so you can click through and go grab the things that I'm talking about. But first, let's don't forget the ebook. If you haven't already read the How to Use Market Data ebook, it's free and it's really, really useful. Scripts, there's different talking, and in a time when the market is changing like this, can be really useful. Market data now more than ever, people need you to communicate about what's happening in the market to them, help them see right now. Okay, so there's a bunch of big questions happening. Mortgage rates are falling, finally. They are falling again today. And the question is that going to motivate buyers? And how motivated will they be? How quickly are they going to get moving? We've had this really tight sales environment for over 2 years now, 2 full years. And is that going to finally start loosening up? Are buyers finally going to be motivated? On the other hand, we've had inventory growing. Is inventory going to keep growing? Inventory has been growing all year. What's going to happen there? What about home prices? Home prices have actually been up by a bunch of measures, have been up year over year in this time when sales are fewer. So what's going to happen with home prices, and what can we see? Any sign of the sales rate recovering? And then, of course, we're going to spend some time on the local markets because there's some real local markets changing this year. Before I dive into the data, the webinar is recorded. You will get, everybody who's registered, who's on the call today, will get an email today with the recording. You'll be able to go download it, see it on the YouTube channel if you have to duck off, or if you want to catch more or revisit what I'm saying in there. So use the chat for any questions along the way. Let's dive into the data. Let's start with mortgage rates today. So mortgage rates are down finally from their peak they actually peaked in May this year, but have been dropping very quickly in the last few weeks. Mortgage rates today, about 6.1, 6.2% for the 40-year fixed rate. What we're looking at here is 12, 13 years of mortgage rates. And each little dot here is the average mortgage rate for a week in the given year. So most of the last decade, under 5%. Then suddenly in 2022, we started under 5%, started under 3%, and rates climbed dramatically during the year. So we have this guy here, so that in 2022, rates started down here and finished the year up here. Most of the year this year, we've been in this fat part of the bubbles, upper sixes, even in the 7%, close to 7.5% range. And that's rates stayed here longer than anybody expected. But now suddenly we've shifted down. We're at the lowest point in the year. And with any luck, mortgage rates may be lower than any point in the last 2 years in a few weeks. And so the question is 6% enough to motivate buyers? Earlier in the year, I was assuming that we'd been in this 7% range, that anytime we got under 6.5, we would start to see buyer motivation. And frankly, it's been really hard to measure changes in buyer motivation in the last 3 or 4 weeks when we've had rates under 6.5. I expected we would. We haven't really been able to see it. So I'm looking now. Is it 6% that there's a threshold? It's late in the year. It's the second half of the year. So we missed the big window. And it could be that there are would-be home buyers who are like excited about lower rates are simply have already decided to wait till the spring. So that may be why we haven't really seen a notable change in purchase rate. But there are going to be a couple of places where we might be able to see it in the next week between the end, basically through the rest of September and early October, comparing each of the last 2 years, because these stretches here with mortgage rates above 6.5 or 7 in 22 and 23, this all happened in the late in the year. So our fourth quarter comparisons are going to be easier this year. Maybe we'll see home sales higher than the last 2 years. And I'll show you what that means in a sec. If we look at the mortgage rates at the average, the median price of the pendings, the homes that people are buying, what we can see right now is mortgage rates peaked in May with rates compared to the light red line from 2022, where rates were still super low in January 22, and how dramatically mortgage payments changed in 2022. By September of both of the last 2 years, we had extra rate jumps. And so we had affordability weakening in these 2 years. What we see now is this 2024 line. Rates are falling. This is last week's rate and last week's median purchase price, the median pendings price. Rates fall again. By the middle of September, we could have an affordability, like the most affordable environment we've seen in 2 years. And I think that'll be a notable change, and it'll be fascinating to see if it motivates any buyers or if they're going to wait till spring. But this is a pretty dramatic change in the last few months. And so even if we don't really see pickup in the fourth quarter, relative pickup in the fourth quarter, if we end here in significantly more affordable payments over the last 2 years, that would set us up for a much stronger 2025 in terms of home sales. And looking at affordability, it's a fascinating trend. And we've gone from really less affordable to maybe the most affordable in a couple of years. And so that's a powerful trend underway. Okay, so what does that all mean in terms of the inventory? So there are now 704,000 single-family homes unsold on the market across the country. That's 30% more, 38% more homes on the market now than last year. Inventory actually has ticked down each of the last 2 weeks. So at the far right of the chart here, you can see the last 2 weeks is a plateau in the total number of unsold homes on the market. I've highlighted a few things here. Last year and 2022, in September of each of those years, mortgage rates spiked. And when rates climb, inventory climbs. It becomes less affordable. There are less buyers, so the inventory builds. And so you can see from September of 22, Inventory climbed into November. You can see last year, September, we had the right spike. Inventory climbed all the way until late November last year. But if you look back in 2019 or these previous years, you can see that normally inventory is at a plateau, bouncing along a flat level starting in July or August, up and down, and before declining normally in October. So you could see where we'd normally be in the plateau period. We're later in the plateau period now. We haven't, but it does imply that because we're not in that, we're in the opposite environment we've been in the last 2 years, that we should see inventory basically stop climbing. It'll bounce up and down a little bit over the next probably 6 weeks, but before falling in October. And so what that tells us is that if inventory is basically stopped climbing for the year, that is indicators on things like slightly more people purchasing. That means there's also a floor on things like pricing, because we have a floor on supply, or a ceiling on supply. We're not getting out of balance in supply. So you may have people in your orbit who are still waiting for that home price crash. And as of right now, there's no signal in the data of inventory climbing super late in the year. In fact, it looks like we're about at the plateau and probably start receding for next year. And I'll show you again a little bit more of that. So there are two sides to that inventory build, which is, one is the seller side, how many people are selling their homes, and the other side is demand side. As I mentioned, we haven't really been able to see a pickup in demand. We'll get into the pending sales in a few minutes. On the new listing side, there were 62,000 new listings unsold this week across the country, single-family homes. And you can see the dark line right here is still lower than any of the gray lines from previous years. A few more sellers each week than the last few years, than just last year. A few more sellers than last year. Fewer sellers, though, than normal. And so, again, like, this has been the story all year long. A few more sellers than 23, but still restricted in terms of overall seller volume. And that is one of the things that keeps a lid on inventory growth. And as long as we have a lid on inventory growth, that's going to keep things like supply and demand in check enough so that we don't see dramatic price decreases in the cards, because there's still plenty of people who are worried or expecting home prices to drop dramatically. They're expecting the housing market to be tanking. And so while we still haven't really seen any pickup in home sales, the seller volume is still really very low. You can see a little growth over 23, and I would expect 25 to have a little growth over 24. So each year we're getting a little closer back to normal, a little more sellers, a little closer back to the normal levels of inventory, pre-pandemic levels of inventory, a little more balanced in supply and demand, which basically means another year of very flat to home price growth without a ton of home price appreciation. So that's on the seller side. If we look at the total inventory, I've been showing this map in these webinars for a few months now. The redder the state here, the greater the inventory growth over last year. So Arizona is now leading the country, 72% more homes on the market now than last year at this time. Arizona had a pretty strong 23, a surprisingly strong 23. And I'll show you that when we get to the local data. I'll show you some Phoenix data that I'm looking at. Florida is 64% more homes on the market than a year ago. And you can really see across the South, more homes, the Sun Belt, more homes on the market now, where the Midwest and Northeast, New York, Illinois, these have only fractionally more homes on the market now than a year ago. And many of these are still barely coming off the pandemic lows. And so what's happening here? One of the things that's happening here is The Sun Belt states have been were the inbound migration states, and they boomed during the pandemic. Big inbound migration. You move from Chicago to Phoenix, you move from New York to Austin or to Florida, right? The inbound. And so you have things like construction, you have investor activity all through the Sun Belt. And then in the last year, as mortgage rates climbed, interest rates have climbed, migration patterns have slowed way down. So in fact, some places in Southwest Florida have actually negative, like outbound migration now. Austin, Texas may be negative this year, net outbound migration in Austin, which is just fascinating because it's such a boom growth market. So we're in a place where the inbounds had a housing market where you're expecting a lot of people to come in. The outbound states had a housing market that expected a lot of people to leave, and that migration has stopped. And so the people in Illinois aren't selling houses to move to Arizona, and they're not buying in Arizona. And so that dynamic is really a function of, it's related to employment. So we have low unemployment, but we also have low quits and low hiring. So there's fewer, you might call it the great stay. We're staying in our jobs, we're staying in our homes, we're staying in the towns that we're in already. These are the slower dynamic that's happening in the economy right now. So I talked about inventory has been rising all year. Many of these states, like Arizona now, has 70% more homes on the market, but we're also in a plateau. So inventory across the country has plateaued the last few weeks. And what I want to show here is some states are now starting to compress with 2023. And so the gray states here are now comparing that inventory growth to last month. So Florida, 64% of the home, more inventory, 64% more inventory than last year at this time. But last month, it was 70%. So inventory in Florida in 2023 was climbing dramatically. And now it's not climbing, it's plateaued. So Texas is still up a little bit. Arizona is still up a little bit. Some of the Northeast states are finally growing compared to last year. So, but what we're showing here is that most of the country is now compressing versus last year. And this is why we go into, I'll show you the forecast in just a second, but it's why we can see that inventory isn't going to continue to take off, especially compared to last year. We have 38% more homes on the market now than a year ago. And we expect to finish the year with 25% more homes on the market than at the end of 2023. So the inventory trends are shifting, and we're probably, in most states, we're at the peak, we're past the peak, and we're starting to compress compared to last year. I should mention that one of the reasons that inventory is falling, or flat or falling, is that the number of listings withdrawn is higher than it has been in the last couple of years. So right now we track in the Altos data all the homes that were on the market last week and the ones who are not on the market this week. Those are absorbed. Sometimes those are going into contract. Sometimes they are withdrawn. Sometimes they go into contract and then a contract fails and they get relisted. There's all kinds of reasons there. But for every 2 homes that are going into contract, right now we count one more that is now withdrawn. They're delisted. And so you can see that it is higher than either of the last 2 years. In 22, the market had shifted from super hot to much colder. And so you could see the withdrawal rate, it was climbing in 22. In 23, we had surprising strength. And so there were fewer withdrawals last year. So the bright red line last year, fewer withdrawals. And so this year now we've got sellers who have waited longer. The buyers who were waited longer for cheaper mortgage rates. So one of the reasons that we have less inventory now is that withdrawals are up. And the thing that you can look at that as bearish, right? There's no buyers. So that like more people are withdrawing the listings, but you can also look at it as these are sellers who are in a position of strength. These are potential sellers who are like, well, I'm going to see if I can get the right offer for my house. If I can't get it, I can wait because I have a super cheap mortgage payment or no payment at all. And so I will withdraw and wait till next time. So you can look at the withdrawal rate as both sides. It obviously is weaker demand leads to withdrawals, but because if those sellers were getting the offer they wanted, then they wouldn't withdraw, they'd sell the house. But what I think it's useful to know, and what we're going to watch with the withdrawal rate is by the end of the year, and as we start 2025, are the withdrawal rates, do they start coming down? Because that would be an indication of demand resuming. Obviously, around the holidays, you can see at the left end of the chart, the holidays are when people withdraw and, like they're like, take it off the market. We'll try again later. It happens a ton. And then we have the most inventory March, April, May. If it's still on the market now in September, you start going, well, that didn't happen and I'm going to withdraw it. So you have a normal cycle there. And so we're going to watch that for next year. And I think it's important to note that withdrawals are elevated, especially compared to last year, but not that as elevated as compared to 2 years ago, because that's when the market was slowing down most dramatically. All right, so let's put all that together into the projected inventory curve. In this chart, I'm taking the inventory number. Each line is a year. You can see at the top, the 2019 chart, peak inventory in that year was in June, and we bounced along a plateau until into October before the seasonal inventory decline. You get withdrawals, you get fewer listings to reset before the spring. And so looks like we're in this sort of September peak plateau. We have a few more weeks in the model that are expecting inventory increases over the next few weeks, with a high of maybe 720,000 single-family homes. And then we're going to finish the year at about 635,000, which would be a 25% increase over 2023. And you can see how each year inventory responds to different macro market conditions. You have 22, when inventory started off at the record lows, climbed dramatically in the year. You have 21, which is prime pandemic frenzy time. And then you have 2019, this is the old normal. So next year, if rates stay elevated, you'll continue to get more inventory growth. We'll start the year at 635. And so maybe we peak in 2025 in the 800,000 range, getting much closer to the old normal levels of like 1 million homes on the market at peak summer times. That's what we're looking at right now. One thing that's going to be fascinating that I'm going to be watching for in the next few weeks is, do we get these last few inventory bumps through October, or are we actually at the peak and start receding? Both if we have a few more withdrawals, we have slightly more purchases taking advantage of newly lower mortgage rates. Any of those things happening over the next few weeks might keep this curve lower. We might have to adjust the curve lower with a new reality in mortgage rates. So probably end up the year with about 25% inventory increase, and we will and then set the year 2025 up for a more normal season. All right, let's switch into sales. So there were 62,000 single-family homes that went into contract this week. You can see the 2024 line is sort of right in between the last 2 years. The interesting thing to pay attention to on the sales rate. So these are the new contracts that get started each week. This light red line this is 22. And in the middle of September in 2022, the home sales took a big drop right when mortgage rates did their second jump to 7.5%. This was consumers walking away from the fourth quarter. And in the next few weeks, we could see a stronger fourth quarter because we have the opposite conditions happening now. So what if we end the year up? Will still be low, really low. We're still only on par for about 4 million home sales for the year, but we could finally start having some of that seasonal adjustment improvements in the headline numbers in the fourth quarter, because the last 2 years have been really lousy fourth quarters. And so we're kind of set up for a slightly better fourth quarter here. We haven't seen an uptick yet. We haven't really seen it getting higher, but this little window right here is where, in the next few weeks, where it could happen. So keep your eyes open for the sales rate. And then this is a total sales rates, total number of contracts in homes in contract at any given point. 2022 started with a ton from the pandemic boom. At June, if you didn't get into contract by June, you were walking away. We could see contracts took a big drop in June of 22. Here's that September rate spike. Contracts took a big drop there. We had a big rate spike last September too, and it was a slighter decrease in the contract number. But so again, we could end the year with slightly more homes in contract, and that would be an encouraging position that shows us that consumers are responding to lower mortgage rates. If we say, so there's 359,000 homes in contract. When we finish the year, there's about 260, 270. If we finish in this same exact range as we did the last 2 years, that's telling us that consumers don't care about the lower rates, or they're not low enough yet. And so there's a real signal to be watching for in the total contract pace right now. Still on pace for 4 million home sales. We'll start to get the seasonal adjustments where we get to bump that up if we get lucky in the fourth quarter. Okay, so let's talk about pricing. The median price of single-family homes in the U.S. is $445,000 now. That is essentially unchanged from last year. So that you could see the dark red and the bright red from last year, a little bit higher than 2 years ago. 2 years ago, prices were falling because, that's when the market was slowing the fastest. And if you remember, we could watch prices falling from the peak in June of 22. We watched them fall in August and again in September and October. And the headlines reported year-over-year home price decreases in the sales numbers were happening in March and April of 23. So you could see it in the pink line here in the fall of 22. The headlines reported it in the spring of 23. So right now, what we're looking at is that the headlines are going to get closer and closer to unchanged 0% home price appreciation over last year. The headlines like the Case-Shiller, depending on how you read them, are like 2 to 3 to 4 to 5%. Some of them are still reporting 5 or 6% home price gains over last year. They're really looking back at lagging data, and I believe that those headlines are going to start to come down in the rest of the year. So there's a different view, but it supports my point here. We're looking at, in this chart, the year-to-date gains. So home prices are basically at their lowest point in the first week of January. Then new listings come on, you get buyers in the market, prices climb in the first and second quarter to peak in May, and then they start receding in the second half of the year. You can see the pink line was 22. We were still trying to get deals done before rates climbed. It was still in the 4s and 5s. And so then in June of 22, big price drop. If you weren't going to, the people who are still doing contracts by July were doing them at a discount to the ones in June. And then this other big drop in September and October with that second rate spike. And so you could see the prices change when you compare it to the beginning of the year in 22, really directly correlated to mortgage rates. Last year, we finished up the year, and all the fourth quarter, we were up over 22, and we finished up, home prices finished up a few percent last year. So then we look at this dark line for this year. And so all the price gains happened in the first and second quarter, and we had fewer price gains in the first and second quarter this year. Mortgage rates stayed higher for longer than anybody expected. Now we're on the downside, and you can see how we'll bounce around here, that we could go, we'll probably have an uptick next week, but you can see how we'll end the year aiming for essentially a 0% home price gains. It could dip below, could be negative, or it could be a positive. Like anywhere in this range it can move in a given week. So I don't read too much into any 1 week change, but I do look at this signal 1, 2, 3, 4 weeks in a row of these price adjustments. That was consumers. You could see it immediately in the data when consumers were responding to new higher rates in 2022. So this is a leading indicator. It's a signal for how the year is going to curve, because the year follows this normal curve. And it really looks like we're going to bounce around here at about 0% home price gains from last year. It could be down or it could be up a little bit, but right in this essentially flat range year over year. So then let's look at prices at the state level, and then we'll switch into some local data. We'll do price reductions in the local data. So we have the bluer the state, the better the home price appreciation year over year. The redder the state, the less appreciation. So we have a couple states which are negative. These are anything within plus or minus 2% are basically unchanged year over year. So Texas, Colorado, Tennessee, Florida, Arizona, like these prices are basically unchanged year over year. They could tick down in a given week or tick up. But you can see the northern states are where home price appreciation, New Jersey is still at 10% this year, 11% here. Like that's really fascinating to see exactly where the demand is and where the migration has slowed down. And I mentioned, the people moving out of these regions and into these regions, that migration stopped this year. And so inventory is up through the South, the Sun Belt. Inventory is down in the Midwest and Northeast. And because inventory is so tight, that is keeping a floor on home prices. And so you could see a real dramatic difference in home price appreciation across the country this year. Price reductions real quick. Price reductions have sort of plateaued over the last few weeks. 39.8% of the homes on the market have taken a price cut, actually ticked down a little bit this week. The important thing here is we'll probably have more price reductions before the end of the year. Usually it ticks up a little bit in October and November before resetting in the holidays before the beginning of the year. But we will not have these big jumps that we saw in 22 and 23, because these were exactly when the mortgage rates climbed in 22 and 23. You could see exactly how home buyer demand was impacted, slowed way down. Any sellers who were trying to sell, who still had their house on the market, had to do price cuts. And so these were very bearish signals at the end in the fourth quarter of both of those years. We have the opposite happening now. The gray lines are for last few years. So more homes on the market now have had price reductions. Like it's obviously a slow market, but it is not transitioning like it was in the last 2 years. Very different market now. All right, let's switch to local data and dive in here. Okay, let's start with the price reductions at the local level. So this is the Altos platform. I've got the advanced analytics page up, and I have my queries set up that I want to watch different trends across the country. So I have the ranking of price decreases, percent of homes on the market that have taken price cuts. For most of the year, the Florida markets were the slowest markets in the country. But recently we've got Austin and Denver and San Antonio that have climbed up here's Dallas. They're climbing up. So you can see that the inbound migration market's much slower. The Florida markets are still slow. Tampa's at the top this week. But you can see, it's Pensacola and Sarasota. For much of the year, Sarasota was the slowest market in the country. So over 50% of the homes on the market have taken price cuts. That's a significant number. That's fairly bearish. You can see, though, if we look at Phoenix during 22, started at very few homes needing price cuts. By the end of 22, over 60% of the homes in Phoenix had price cuts. And right now is 46. So Phoenix is in a much more normal zone for Phoenix than it was in 22. And I think that's a fascinating change than what, in terms of future indications of pricing for places like Phoenix. So really, we're looking at the Texas markets now. And I've got Phoenix and Tampa. I got a bunch of these open that we can dive into. A couple of the other charts I have open. I'm watching sales prices in Florida. If I look at this chart here for all of Florida, these are the weekly pending. So these are the homes that are going into contract each week. And you can see the prices in Florida peaked in April earlier in the year, and they're starting to tick down. And it looks like you could imagine Florida finishing zero or home price decreases over 2023 with this pattern here, somewhere in this same range. So this is Florida as a whole. And so you can really see where the demand is shifting. You can see the 22 line had strong Q1, Q2 of 22 and stronger price decreases in the second half of 22. You can really see that impact there. Okay, let's dive into some local data. I mentioned Phoenix. So Phoenix is fascinating to me because if we look at the price trend for Phoenix, I've got Phoenix median price here. The pre-pandemic years through the June of 22 were just unbelievably strong demand years. 22 dramatically, demand dropped really fast in 22. And in this moment in 22, I was asking, would investors in a place like Phoenix, would they be selling in panic and exacerbating a downturn? Or would they be buying and putting a floor on prices? I didn't know. You don't know what the behavior is going to be. In 22 and 23, we saw that prices dropped into a newly affordable range. You have better cap rates. And so we could see investors move in and put a floor on pricing in 23. So home prices and inventory recovered in Phoenix in 23. And it was surprising to me, they behaved very dramatically. Now we've got prices receding again. So year over year price declines in Phoenix, cheaper now than a year ago. We're not yet at the low point, right? Prices will do their seasonal turn up in January. But what we don't know now, as we know in 23, there was still a lot of investors and businesses with pandemic cash. They still had a lot of strong economic growth, cash in, a lot of government stimulus, a lot of cash. And so that was put to work in 23. Will we see a different pattern in 25? Or will we see a floor and some of that opportunity, that investor opportunity, happen again in 25? It's going to be fascinating to watch that pattern. Let's look at inventory real quick to see if inventory is, so inventory is in a normal range in the Phoenix metro, 12,000, a little over 12,000 homes now. You've got the pandemic years where it was 3,000 homes. You have 22 where suddenly nothing was selling. Inventory built way up all the way until November of 22, and the faster recovery of 23. So we have a much slower market, a much slower place, and you can see in Phoenix, anything above $1 million is significantly slower. Anything under 650 is still moving pretty quickly. So you can see the demand price point in Phoenix, and you can understand that anything under 450 is a real strong investor buy box. So those probably still has opportunity there. Let's look at Tampa next. Tampa is one of these others that, pandemic strong inbound, slowed way down in 22. This is the inventory chart in Tampa. We're now at highs, 5-year highs, at normal or maybe more than normal homes on the market in Tampa. In the last few weeks, we can even zoom in here and see in the last few weeks, the inventory has actually plateaued, maybe ticked down in Tampa. So maybe we're at our peak. And in fact, normally this time of year is around the peak of inventory for Tampa. So it's not uncommon. So if inventory in Tampa were climbing dramatically now, that would be news. Price reductions in Tampa right now, 55% of the market has had price reductions. It's pretty high. And you can see anything close to $1 million is slower, but the whole market is slower than Phoenix. Like every price point is slower than in a place like Phoenix. And let's look real quick at prices. Prices have basically unchanged for 2 full years in Phoenix, and on the downslope part of the year, the down season, in Tampa, with no indication of any like upward price pressure. Now, I mentioned that people moving out of the Midwest to Phoenix and Tampa, those markets, that migration has slowed this year. So in a market like Cleveland, normally you're in outbound migration mode and you sell your home. And so 7,000 listings would be normal in Cleveland. During the pandemic, we were buying everything everywhere. But right now there's 2,000 homes on the market in Cleveland. And that's because those people who would be moving and selling are now sitting still. They're holding on to their job. They're holding on to their house. They're holding on to their existing cheap mortgage. And so we are barely off the pandemic lows of inventory in a place like Cleveland. You could see high end of Cleveland is still only 42 days. You've got, less than a month time in the mid price points in Cleveland. You can see slightly longer time at the cheap price points, and it's because these are 100-year-old houses that are very small. These are not as livable as the mid price points in Cleveland. So this is what's the difference between the boomtown Sunbelt and the Midwest and Northeast. This is the big difference across the country. And as a result, let's look at prices. Home prices are up in Cleveland this year. They are higher than last year. You've got your seasonal pattern, and we can also look at price reductions. So all of these things, fewer price reductions than normal in Cleveland. So that's the difference, what's happening in the market across the country. Chicago's in the same category. So this is inventory in Chicago over 5 years. Right? 40,000 homes or 35,000 down to 10,000. You can see a slightly longer market time in different price points, but still dramatically tight inventory compared to normal because there's significantly less outbound migration happening right now. Price reductions in Chicago are only at 30%. So only 30% of the market has had a price cut in Chicago. And that's because inventory is super tight and there's very few sellers that need to unload. Okay, I got a few more markets. Let's look at Charlotte. Charlotte is actually kind of a fascinating space because we have what we call the halfbacks, the people who move from New York to Florida, and then out of Florida, move halfway back, and they move to places like Charlotte. And so Charlotte actually still has a better inbound migration pattern this year than places like Southwest Florida, for example, or Austin. Over the last few years, though, in Charlotte, we have just barely increasing home prices, 450, like 1 or 2% each year, which is a much healthier pattern than moving at 15% a year. in Charlotte, and so like it was earlier. We can see all price points in Charlotte are relatively fast in terms of days on market. And we can look at the inventory in Charlotte. So Charlotte inventory is up this year, but still fewer than pre-pandemic, maybe 10% fewer than in 2019. So inventory is climbing there significantly. It's a different pattern than the Midwest, but it's also a different pattern from the real Sun Belt, the real the boomiest of the Zoom towns that we had during the pandemic. Really fascinating happening. So Charlotte feels strong. Even so, it feels strong because inventory is less restricted than, say, Chicago or Cleveland, but it is not on there's no flood like there was like you might see in some of the Texas markets, for example. In the US West, Salt Lake City and Denver are ones that I've got up today. We have in Salt Lake City, I'm looking at price decreases. So Salt Lake City was a very strong pandemic boom market, but it has been a growth market for more than a decade. You could see, at the start of 22, only 8% of the homes on the market in Salt Lake had taken a price cut. 8%. Got up to almost 60% by the end of that year. You could see a real slowdown there. But each year, we're in slightly better, more stable market in Salt Lake City than, say, like the Sun Belt markets that we were talking about there earlier. We have so let's look at inventory in Salt Lake City. So inventory is getting closer to normal, but still a little bit fewer than pre-pandemic time. So a little more available, taking a little longer to sell. The high end of the market, the $3 million homes in Salt Lake, are obviously slower, and you can see the price point. The under $500,000 in Salt Lake is where the attention goes the fastest. Salt Lake is an inbound market. It's a suburban market, so you have a lot of you can imagine first-time home buyers going in for the cheapest homes available in Salt Lake City. Let's look at Denver also. So Denver's one I actually have a little more concern about than, say, Salt Lake. Denver has more inventory now than pre-pandemic, and is at its peak for the year, and it'll start coming down. But Denver seems to have more slowing, and Denver slowed really dramatically during 22. Like, look at that inventory climb from 800 homes on the market to 5,500 in September of 22. Really dramatic slowdown. So Denver has has weaker conditions, I think, than many of these other markets that we've been looking at. Let's look at the price reductions really quick in Denver. We're at 50% of the homes on the market at price cuts. That's more than last year at this time. It's not quite as bad as we got at the end of 22, but is higher than normal. In the 40s would be normal for Denver. So this indicates to me that much more sensitive to rate changes, to rate increases if rates stay higher for longer. Like Denver markets could indeed are maybe most price sensitive. And let's actually look at the price changes there. So we have prices down year over year. They are just up over 22. They dropped really dramatically in that second half of 22. And really, we're going to go into 3-4 years of essentially no price change in Denver after many years of big run up. So they're going to stick in the 600 range, I think, is 6 to 7, I think, in the next year. So I have a little more concern about the Denver market seems to be much more sensitive than many of the others in the US West now. All right, that's all the time I've got for. If I didn't get to your market, and I can never get to all of them, you can always go to the Altos Research website and book a free consult with our team so we can go over your local market. We've got data for every zip code in the country, and we can dive in. We could talk to you about how to use the data with your buyers and sellers right now. You can use the free ebook. There'll be a link in the chat that Lael and Jeff will post to grab this free ebook. And it's like, it talks about the data in the same way that I talk about the data. It gives you scripts in this time. Is inventory a lot? Should we pay attention to price reductions? Is it going up or down? What does that mean for me as a seller? If I'm going to list my house right now, or if I'm thinking about listing my house in the spring, what do that price reductions tell me about the market right now? Those are the kinds of things that you should be answering for your clients. They need that value from you now more than ever. So I encourage you to go grab that. If you haven't booked a demo with our team, go to Altos Research and just do that and dive into the Altos system so that you can get started today, get that data into your clients' inboxes right now. I will stick around in the chat. The webinar is recorded. You'll get an email today, follow up, and it's always available on our YouTube channel. So everybody, thanks very much. I'll stick around in the chat and we'll make sure that we have any questions answered. Thanks, everybody.